Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, the recent Federal Reserve meeting, cash transactions, growing inventory, and so much more. But before we get into this, Stephen, what is going on in the Thomas household?
Well, we're watching a lot of Olympics. A lot of fun. This is the time of year where we have a lot of runners in our family. You were a runner. I was a runner. My wife's a runner. And we have a runner that just graduated from high school and another runner that's currently running. So we know all about cross country and track, and this is a lot of fun. And we just like sports. So there's plenty of sports on, and it's pretty much, you could watch it 24 hours around the clock. And so today actually started track. We've had a lot of swimming and a lot of gymnastics, but it's now track. So we're having a lot of fun. And there's already been there was the world record that was won by it was a 4x400 mixed. So it was two females and two males, and they got the world record. So that's what it's all about. It's fun to watch and fun to root for the United States, but it's also fun to see the journey of all the athletes from around the world. So we're just having a good time.
Good stuff.
How about you? What's going on with Brennan Thomas?
For me, not too much. I'm like fully recovered after having COVID, and I went to go see Arsenal last week, which was absolutely a dream come true. Being able to actually see them and like watch the game live is an entirely different feeling, although it's definitely different than what it sounded like when they were playing over in England. So I'd love to see that someday, but only just a couple more weeks now until the season starts kicking up, and then it's go time from there. It's going to be crazy, and I have so much to look forward to with this year. And yeah, I've got the Olympics going on, which is crazy, and there's soccer, and there's just a bunch of sports keeping me entertained. So it's all good stuff. But before we dig into the current real estate market, plenty has happened over this week alone. So Stephen, what has happened with the economy over the past couple of weeks?
Yeah, it's been major news. It's been fun to watch. It really started last Thursday, a week ago Thursday, where we had initial jobless claims were it had spiked, and then unfold to this week. And really, the news was the Federal Reserve meeting, and totally hinting at their September rate cut. And we were arguing that they needed to cut rates, that the longer they wait, the more damage that they're going to cause. And so then after they met on Wednesday, they released their statement. Along comes another initial jobless claims on Thursday, and then Friday, boom! What really hit was this is Jobs Week, Jobs Friday, August 2nd, and the number of jobs created was way less than expectations. And then they revised last month. Remember, it was right at expectations. They revised that puppy about 15,000 jobs less. So it was actually less than expectations versus a little higher than expectations last month. And so it looks like this really, and then unemployment spiked. So remember, we were all the way at 3.5, and that was a 55-year low. The last time we were that low was 1969. And slowly but surely over time, the unemployment rate from the start of 2022 has been deteriorating, and now we're up to 4.3% unemployment. And it's the highest unemployment that drives down to the start of 2021, when unemployment was through the roof and it was coming down from the pandemic. So this is actually elevated. You can actually see the elevation is happening rather swiftly. So there's real deterioration in the labor market. They had already kind of seen this, and they're kind of like hemming and hawing. Should they pull the trigger on Wednesday or should they wait? And now they've chosen to wait. And so there's a lot of talk about that. But in the because of these of what's happened over like the past week, we've really seen rates fall, and they have fallen to their lowest level that dates back to, I think it was March, April. Can't remember, going back and forth. I think
Mhm.
April 2023. So that's more than a year. That's 16 months ago. So that's a long time ago that we had rates that were this low. And that's the overall general arching theme, is the economy is slowing, and it's adding to rates coming down further, because there will be more rate cuts to come from the Federal Reserve, because they're going to react to all of these economic numbers as they come out. And so that's where we're at. So this is very favorable for the real estate market, because even the difference from yesterday to today was just it was gigantic. I think you did a post. How big has the rate drop been over like the last few days?
Oh my gosh, let me pull it up right now. It's 0.46.
So
So almost pretty much half a percent, a whole percentage point, which is, I feel like a kid in a candy shop right now. Like, this is crazy.
it really is. It really is. It's a big difference for buyers. Their buying power just went through the roof, and that's huge for the real estate market. If you're an economist for the labor side of things, you're now like cowering in the corner. I think we just saw a cartoon about that, cowering in the corner. But if you're an economist for housing, you're quite giddy right now, because finally you get more favorable interest rates.
So, with all that's happened recently, what have you seen in the real estate world with supply, demand, and expected market time?
So not a lot has changed. We're looking at differences from week to week, and then even over like the last couple of weeks, and we're looking at differences, kind of like mapping it out. This is so new, this giant drop in interest rates, that it really hasn't been absorbed, because we have to be at these lower levels for duration in order for them to really take a hold within the real estate market. So we're not seeing like this giant pickup in demand. I know that the more that interest rates go down, the more that potential buyers and buyers out there will be contacting lenders, and so it will increase the velocity of the number of buyers in the marketplace. But that all takes a bit of time. It's not instantaneous. Nothing in it, real estate, is instantaneous. But we should start to see this in the numbers. But right now, it's really good, because supply has actually continued to increase slightly. It kind of looks like we're hitting a peak in many, many markets, because of the fact that interest rates are coming down. It had, like, the last 2 years, we had this peak during the summertime 2 years ago, and then it was like flat till October, and then it came down. That's not normal. Normally, you get this rise in the inventory and peak between July and August, some markets September, and then it gradually comes down and falls during the holidays. Now, this year is lining up, and the reason it didn't happen the last 2 years is because we had lower interest rates at the start of the first half of the year, and higher interest rates the second half of the year. We hit the high in 2022 in October of 2022, and in 2023 we hit the high in October at 8%. 8% interest rates versus, shoot, they're below 6.5 today. They're about 6.4%. And that's way better than 7.5% where they were just in April. And here we were at 8% back in October. So the second half of the year, we're actually going to have interest rates that are lower than the first half. So now we're going to see the normal cyclical supply. And what we're going to see is it's going to peak out right around now. Since it didn't peak out in July, there are some areas, it looks like the Bay Area actually peaked in July, but all the other markets look like they're about to peak or have peaked. So it would be the end of July, start of August. And then, like I said, after you peak, what is a normal market, especially with rates coming down, is we're going to see that the inventory starts to come down as demand doesn't really diminish, because demand isn't really changing much from week to week, and it's very similar to last year. You just need a few more pending sales for this demand curve to increase. And now we're going to have more pending sales than last year. So that is to come. We're just not seeing the numbers. So what we're seeing is inventory still coming up, demand kind of flat. But if you have inventory going up and demand flat, that's still overall the market time is increasing a bit. not as heavily as it had been over like the course of the last couple of months, but it's still a bit. But this is week to week, and what we're going to start to see is that the inventory is going to start to come down, and demand is flat or goes up a little bit. And if you have that, what's going to happen to market time? It's actually going to come down, and that's what we think is going to happen going forward. So if you want a prime time to actually be in the market as a buyer, it's actually right now.
That's good stuff. So earlier this week, we also had a Federal Reserve meeting. So would you mind touching on or talking about what happened?
Yeah. So, like I said, they were hemming and hawing and wondering what they should do. And Jerome Powell's presser that they actually he has a press conference. He delivers a speech, then afterwards takes Q&A. So his speech sounded like normal. And they just changed the language here and there, and you look to see what the differences in languages indicate. But more importantly, is actually the Q&A that follows it. Back in the day, they didn't do any of this stuff. They were not as transparent as they are today. But boy, are they transparent! As a matter of fact, when Jerome Powell was up there, he was kind of like hemming and hawing and didn't quite know how to answer things, and it very much articulated that that there was discussion in the room of cutting this week, and but they opted to wait until later, till September. And yet I'm now listening to some of these Fed presidents that are coming out, and they're trying to save a little bit of face, because there was a lot of indicators that indicated that you should go. And I think that a couple of the Fed presidents that I actually heard from were actually, they wouldn't tell you where they're at, but you could tell that they were leaning towards going this week. So now that they've waited, they look like they kind of had egg on their face, because they should have already gone and then made another rate cut in September if this continues to go down the route around the route that it goes. So they're kind of between a rock and a hard place, because now that they've decided not to do anything with interest rates, we're seeing long-term interest rates come down in anticipation of where the Fed is going to go. And because we have this deterioration in labor, and the overall economy is kind of like showing that in many different aspects. So because it's showing that it is definitely articulating that they're going to need to make cuts. So that's why long-term rates react prior to the Fed even pulling the trigger. So even though they didn't pull the trigger, today's news on the job front is telling them, dude, you probably should have gone on Wednesday. Since you didn't, it's already priced at 100% for this coming up September. That's what the odds are, that they're saying that everybody thinks it's 100% chance. And that's pretty rare that it gets there. And that was prior to today's report coming out. Today's report's now having everybody saying a lot of different things, like perhaps they are going to have to do two rate cuts, one intermittent one in between, which they're not going to, one in September, which or maybe a 50 basis point in September. So they do one in between, one in September, where they do a 50 basis point drop in September. But even that will they can articulate that, gosh, we should have moved in July. Now that we've had more evidence, that we're doing this half point. The problem is they want to save face and act like they knew it all along. And that's the hard thing that I have with the Fed, is that they don't say, you know what, we kind of made a mistake, and we're only one policy date off. So 45 days later, we're deciding to go. So we're going to go ahead and make that choice. So I hope that's the direction that they go if there's more numbers that line up. But they could ultimately only do a quarter point, and that's all they do in September, which at least will be the right start, but they should probably do more.
So are 3 rate cuts in 2024 on the table?
Absolutely. I mean, I was talking about it even prior, that I'm still not convinced that we weren't going to slow down enough. And you even mentioned this thing, it's this index that I follow. It's Claudia Somm, this really intelligent gal that came up with a way of indicating with unemployment and different things when we're actually in the midst of a recession. Well, guess what just clicked today with unemployment that drove up to 4.3%. Claudia Somm's index clicked recession. So this is that whole thing of why I even said, even prior to June, that they probably should have been cutting rates earlier this year, as early as when they first met, the very, very start of the year. So they should have been doing it in January, definitely in March. And they've had so many Fed meetings since then that it kind of like they needed to go but didn't. And now that they keep on waiting, they didn't in June, they didn't in July. And it's like they're waiting until it's too long. And the cookies have been in the oven for too long. Those cookies aren't going to taste good. So they had the ability to cause a recession. Now, if they do that, that's where you get the bigger. If numbers start turning really quick, that's where you're going to see them. They're going to have to react. They don't like to be. They don't really want to go 0.5% in September. Why? Because they really don't want to affect an election. He's even said it. They're not political at all, so they really don't want to be accused of dialing in and being a part of politics. And you know that if they make a quarter point or a half a point, or if they go in between and do it again in September, man, you know that there's candidates that are going to be very upset that they did it, and it will have nothing to do with politics. It would be having to do with they're still way too tight, like what we talked about before. They need to go sooner rather than later. So they meet in September, and then they meet the day after the election. That's the second time they meet. And then they meet in December. So the odds of 3 rate cuts are going up with each report that comes out. And you can actually see it as of today. The odds of future rate cuts have actually increased for the subsequent meetings. So now it's looking more like they were saying only 1 is on the table. That was what it was. Now, definitely it's 2. And now it's just, do we have enough economic numbers where it would be 3? And there is definitely potential in that happening, because everybody was in such a different camp just 60 days ago. And I thought, that's not the camp you should be in. We were talking about the slowdown coming either in the spring or the summer. And small chance that would happen in the autumn, that we'd wait all the way that long, because we just saw too many headwinds. So it didn't happen in the spring, but it's happening in the summer. So we gave it like 5% chance in the fall, but 50-50 with the remaining amount at 95% chance. So it's 47.5 and 47.5 chance that it would be spring or summer, and it's just happening in the summertime. And shoot, it could be even more than, they could go 3 times, but it can be more than the 3 1/4 point drops. They could do more if needed. So we'll just have to see how everything shakes out.
So the Bank of Canada has now cut rates for a second time, and people are still complaining about inflation. What can the United States take from another G7 country?
See, what they're complaining about inflation is that things just cost more. Nobody's going to fix that. Nobody. If you cause a major recession where people lost their jobs and no longer going to restaurants, there will be companies that go out of business and everything. And then in order to compete, prices would come down. But now you have a disastrous recession. So you don't want to root for deflation. What we're talking about is they want to bring inflation into check. And it is into check. You're not seeing that $15 margarita go from $15 to $18 to $20. That $15 margarita is still $15. It's not changing. So we're not really seeing that much more inflation. People are complaining about the inflation that has already occurred, which is 110%. Everything's related to COVID. It was related to COVID and the policies surrounding getting out of COVID and the bridges to get the economy from one side of a pandemic to the other. So and there was inventory problems and everything else. We're catching up. All that stuff's being caught up. And now we're going to have the reverse. So we're going to have a slowdown in the economy, and everybody realizes it. And Canada's a little bit different, and so is Europe, because now they have a lot of adjustable rate mortgages tied to real estate. We don't have that. Most of the real estate that's tied to any kind of rate fixed, and fixed is huge. So that's why we have a total advantage compared to other countries. These other countries feel even more pressure to go sooner because they're causing a lot of strain on their economy. So they don't have the same amount of strain on the economy in the United States. So you can't compare us completely to Canada or to Europe, but there are definite signs. We already see it. Inflation's coming down. It's not going, your $15 margarita is not going to become 12. were $10. Like I said, that is the wrong kind of an economy. You don't want to root for anything like that. You want your $15 margarita to remain $15 and for your wages to go up a little bit amount each, year, and it becomes easier and easier to buy that $15 margarita. That's what you want to root for. And so we're getting inflation that's in check. It's at that getting closer to that 2% target. And they like that 2% annual inflation bump per year. If you do 2% based upon anything, that margarita is now, that $15 margarita is $15.30. So you're not getting that big bump. So inflation's coming down, economy is slowing, and now you're seeing it in the jobs and unemployment. This is where things are getting a little more dicey. This is why they have to go. It's not because other countries are doing it. It's because of what we said, that we saw a lot of different headwinds and things that weren't quite in the numbers yet. And everything that we're hearing anecdotally across the United States from different companies and different walks of life, that there is a definite slowdown that is occurring. It's just going to take time to show in all the numbers, and it's starting to show.
So as rates have been dropping bit by bit over the past couple of weeks, we're seeing a trend of less cash transactions as sales could potentially start to pick up. So I was wondering, is this a trend that we could see going forward?
Oh, for sure. What's really happened with the number of cash transactions are actually down compared to where they were during in the boom year of 2021, but the percentage of the total number of sales went way up. Even though that's down, the number of transactions with lending really went down. That tanked. So that's why the cash became a bigger piece of the overall puzzle. But as interest rates float down, now you're opening it up to more and more borrowers that are out there. Now these investors are competing with buyers with loans, and there will be more competition surrounding that. So as interest rates come down, we're going to see more and more buyers that are needing loans entering into the equation. And as interest rates come down more and more, this is more favorable for all the homeowners that feel like, gosh, I really can't move because I can't afford to move because interest rates are 8%, and we have this interest rate right now at 4%. Well, it's a lot better when we have interest rates at 6% and your interest rates at 4%. That's doing better. And we can make a definitive argument for interest rates coming down even more into the fives, just based upon the spread. I think we'll talk about more of that later.
So with rates declining recently, we've sort of talked about before with the mortgage rate lockdown that once there's a five handle in front of the mortgage rates, things will start looking prettier, per se. But when would you say would be a good time for people to refinance their homes that have had mortgage rates above 7%?
A rule of thumb that I don't claim to be a mortgage professional. I leave that up to those professionals. I like to stick to my lane, but I was told by a really smart guy, and he, feel free to put your comments in the comment box if you have your own say so, your own little catchphrase or elevator pitch that you give people. But pretty much what I've heard is when interest rates fall a whole percentage point less than your prevailing rate, it's almost an automatic yes. And you could imagine when we had interest rates at 8% in October, and that people closed on those interest rates at 8%. And then by the time we got to December, interest rates had got all the way down towards 6.5%. I think it was 6.6%, which rates are lower today than even then. But at that 6.6%, it was such a big, giant difference. It was more than 1%. It made sense for them to refinance. And that is exactly what we had. We had a tiny little refinance boom. But as we have these rates that have really come down, this is going to open up the door for a lot of people to refinance. Because if you have an interest rate at that 7.5% and interest rates today are at 6.4%, it makes sense for you to contact your lender. And the number of times you can refinance, I've asked many people, lenders, exactly how many times you can refinance. And they said as many times as your little heart desires. As long as there's not a clause that says you can't refinance for the first 3 months or something like that, which there's not a lot of that out there. But shoot, this is a good time to look at it. Maybe you should refinance, because even if rates drop another whole percentage point, you could do it again.
So we always take a look at the 10-year yield and the 30-year fixed mortgage rate. As we know, there's like a dance between the two. They go pretty hand in hand. How has the spread been over the past few months?
Well, we've talked about it before, and the spread actually got better from December to now. So the spread was actually more than 1 percentage point. So really, what happened is the spread, the average spread going back to 1972, and I'm going to totally geek out on this with Freddie Mac's mortgage market survey, which goes back to 1972, and looking at the 10-year Treasury all the way back then, and you see what the difference is. The average spread is 1.71. So you take the 10-year Treasury. You can go onto CNBC and Google 10-year Treasury. It looks at a pretty graph. It'll tell you where it's at right now, and it's right now below 3.8. Blows my mind. I can't even believe it. But anyways, you take that 3.8 and you add 1.71. That's where we should be. If you actually do that, interest rates should be a lot better than where they are at today. And that's because the spread has gotten less favorable. And so if you do that math, we should have interest rates right now at about 5.5%. So we have room for interest rates to come down further and nothing happen in the economy. And what is making these interest rates as high as they are? Why is the spread larger than normal? And that is because of all the uncertainty, because of the Fed policy. It threw a lot of uncertainty into the mix, and that was because of the worry of all the people that would want to refinance. So, like I said, just in April, we had interest rates at 7.5%. People today can refinance and save money on a monthly basis and refinance just a few short months later. This is, 4 months later. That is something that I would advise them to do. Now, the bank is going to take a loss on that. And servicers that bought out the rights to service that loan are going to take a loss on that. So what's happened in the system, the ecosystem of lending, is lenders have charged more, servicers have charged more, everybody's charged more. So the spread is larger because they know that the Fed is doing this little dance until they get things under control, and they're going to bring things back down towards a more neutral rate. It's not where they were at 0% for such a long period of time, but it's not at 5.5 where they are right now. That's too restrictive. A lot of people are arguing where it's at. Let's just call it 3. They still need to come down 2.5 basis points to get down to that 3. So you can imagine that rates have a long way to go. So it's once they're making their way towards that, you're going to see the spread get better and better, and it's actually going to slip back. So as we get to more certainty, inflation's is in check, and the Fed's policy isn't as restrictive, you're going to see that extra 1 point is actually going to dissipate. So nothing even will happen in the economy, but rates will slowly but surely progressively get better. And you can already see that it's gotten better since December, and it's only going to get better in time. So if we get interest rates that will continue to fall closer towards 6%, you can make a valid argument that once everything is normalized again, interest rates can make their way all the way down to 5% or perhaps even into the upper 4s. And people think that Stephen, you don't know what you're talking about. But yet I do, because this is what we do. This is what we follow. And so there is the pathway. That's not happening in 2024. Could it happen in 2025? Perhaps. No one has a crystal ball. I didn't think Claudia Samm's index was going to go all of a sudden trigger a recession. Does that mean we're in a recession right now? No, but it's an indicator that I had not seen before, that I had been watching, telling people, yeah, look at this index. This pretty much tells you it goes all the way back to the Great Depression, and every single time has accurately depicted when we're in a recession. Once that thing lights up, yes, we're in a recession, and that's what lit up today. So I don't know. It could be a mild one, and but we'll have to see. And is it a recession? I don't know yet. Nobody does, but fasten your seatbelts. We'll be watching this, because that's going to tell us where policy is going to go, and that's actually going to tell us where the real estate market is going to go, because the real estate market will definitely benefit from any overall slowdown in the economy.
So, according to Lance Lambert, U.S. home price growth during 24 months from May 2020 to May 2022 was an astonishing 40.2%. For the past 24 months, so May 2022 to May 2024, home price growth was 5.6. Does this mean that the Federal Reserve is doing their job?
Yeah, I mean, they were trying to use real estate as the vehicle, but also keep in mind that rents were out of control. So when you have this real crush on there's an inventory crisis, and we didn't have as many. They couldn't purchase; they had to go rent something. The good news is we built a lot of apartment complexes, a lot of them. So there's a boatload out there, so they can absorb the difference now this time around for the inventory going down a lot lower. Because what we don't want to see is this reigniting of out of control values going up. So in a way they did, because they really slowed down the overall housing market and allowed the building to catch up. And so that's actually occurred but I'm still leery of what's going to happen in the future as interest rates start to go lower and lower, fueling even more demand. Yes, there will be more homes that come on the market, but the increase in demand will outpace the increase in number of homes coming on the market, which means a diminishing inventory. The inventory crisis continues.
So, on the note of home price growth, what can we expect for home prices for the remainder of the year?
So, based upon all of our readings, normally this would be like a slight seller's market in many markets where you have a slight increase in values. But in the markets that we're tracking, there are certain exceptions to this. And I'm going to get this. I get this from agents all the time. Well, I sold this one house and I did this. I'm talking about the overall arching market for a county, because you're going to find exceptions all over the place. So I'm talking about the overall arching theme, that it's more of a balanced market. It's more what we refer to as buyer friendly. It doesn't mean we're a buyer's market. All those articles out there that are talking about, yeah, it's now a buyer's market, it just makes me sick, because it's not a buyer's market. It's not one, because when people hear that, they start immediately going to the Great Recession. That's not where we're at. And even if there's pushback in prices, there's a lot of years where there's pushback in prices the second half of the year, just because things get a little gushier, a little softer, not as much demand, and maybe some lingering inventory. And so you get values that's come down a little bit, nothing major. There's not enough inventory for values to come down major, period. So even if there's a slight softening, this is what I mean by this is a really good time to come in, because as rates go down lower and lower, there is no way setting up into 2025, if we have rates that continue to drive down lower and lower, 2025 is going to be a nutty year. So we can definitely see, I can plead a easy case for values to go up that 5.6% in 1 year, not 2 years.
Well, thank you everyone for tuning into another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, Bay Area, Phoenix, Las Vegas, everything pretty much, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. And if you have any questions, feel free to post it to any of our social media platforms, or you can even email me personally at info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.
Thank you.